John, more now on that Morgan Stanley plan to turn toxic waste into AAA gold. Here to discuss Wall Street's latest attempt at alchemy is Howard Simon, strategist at Bianco Research. He's also the author of the Dynamic Option Selection System, Analyzing Markets and Managing Risk. Howard, structured products like CDOs played a starring role, as John just told us, in the credit market meltdown 2 years ago, not to mention the $1.5 trillion of write-downs and credit losses. At the very least, don't you have to look at these securities and say caveat emptor, or is there something more sinister here?
Well, you have to say caveat emptor in all cases. One of the things that we should have learned, and I thought that we did learn in the whole credit crunch, is you cannot make assumptions about how a security is going to perform and then rate according to your own assumptions. If I assume you're going to pay me back, I'm going to call you a AAA credit. But what's behind my assumption? We learned in the housing case, we learned in the commercial mortgage-backed case, that those assumptions can crumble very quickly, and what looked like AAA is in fact a high default junk type of security. Let's not make that mistake again. You need to have somebody who actually makes a market-based assessment of what the credit quality is. If you delegate that to the ratings agency, we're going to go right back into the same problem we had before.
Now, Howard, that's quite a dire warning, but tell me this, from an analyst perspective, isn't it possible to take poor quality assets, build in enough collateral protection to earn a AAA, obviously, with a different set of assumptions, much more dire than the ones we used before?
That's the theory, and it may in fact work. And let's put it this way: I hope it's something like that would work. But hope is a bad word to use whenever you're talking about analysis, whenever you're talking about trading. You need to remember that any model is as good as the assumptions that go into it. Another story which hit yesterday had John Meriwether going out of business with another hedge fund. Well, John Meriwether was probably a master at putting models together based on assumptions. He just lost 44% inside of 2 years. Assumptions are something that can crumble. And we are flying in so many areas of uncharted waters. There's so many market relationships that are distorted right now. There's so much uncertainty with the level of government interference in markets and the economy that we can't rely on past data and past relationships and say, well, I think that the very tip top of a very large pile of very bad securities based upon very shaky assets and some modeler's assumptions is going to pay me back. Well, that's just asking for everything to go right. And when you ask for everything to go right, it tends to go wrong.
All right, Howard, hold on to that thought. We're going to take a short break. We'll be back in a couple minutes and talk with you more about this issue. Let's go back to our conversation with Howard Simon, strategist at Bianco Research. We're talking about what you might call Wall Street's latest attempt at alchemy. Morgan Stanley taking toxic assets, turning them back into AAA bonds. Goldman Sachs wants to do the same thing. Now, Howard, on the front of buyer beware, why not just have these firms package this stuff, try to sell it? Investors, you have to figure, are a little warier, a little more cautious now, and will price these securities accordingly, regardless of whether S&P Moody's bless them with a AAA rating.
Well, there's a certain class of a buyer that needs to have the AAA rating. So in effect, what they have said is, please lie to me. Please tell me I'm beautiful, and maybe something will happen.
But if they say, please lie to me, Howard, aren't they just getting what they deserve?
Oh, well, yes, but I mean, we shouldn't be living in a world right now where we're going to say everybody should get what they deserve, because we're in a healing process. We need to have securitization. The banking system simply lacks the capacity to channel credit from all the sources to the people who need it. And besides, one of the strengths of the American economy over the last quarter century was the ability of capital markets and securitization markets to direct credit without the gatekeepers of commercial banks channeling that flow, as they tend to do in Europe and Japan. So we need to restart these markets. I expected them to restart the markets. I thought that they would try it in a different way. than essentially playing the same game of going to the rating agency and saying, give me a AAA on this. That's kind of a bad way for it to be done.
But if the securitization comes back, not every deal is going to be good. No?
Well, of course, every deal won't be good. No, there's no 100% in any market here. The other thing, which I think is a very critical issue, is are they going to retain exposure to the assets that they sold? Another lesson we should have learned from securitization is everybody thought they could take the risk off their books, and we wound up with these structured investment vehicles where you had, you had these gigantic, vehicles off in the Cayman Islands where they said this isn't our risk.
We have to end it there. Howard Simons of Bianco Research.